Hi, welcome back. In these last few sessions, we've looked at a variety of market timing approaches, ranging from non-financial indicators to intrinsic valuation models. But a fundamental theme that ran through all of the sessions is that you can time markets and that you can allocate your assets to reflect that market timing. But in this session, I want to focus on that fundamental question. Does market timing actually work? We all try it, but is it an exercise in futility? To try to answer that question, I'm going to look at the evidence in market timing by looking at three classes of market timers. I'm going to look at mutual fund managers and whether they time markets well. And even if they don't claim to time markets, they do so implicitly by telling you how much cash they hold in the fund. I'm going to look at investment newsletters to see if the writers of these newsletters are prescient about future market movements. And finally, I want to look at market strategies at investment banks that every 3 months come out and give you a preferred allocation mix. And presumably, if they're good market timers, they'll be shifting you more into equities just before stocks go up and away from equities when stocks go down. So let's start with mutual funds. If you look across mutual funds, and I'm talking about equity mutual funds, almost none of them is 100% in equities, because some of the mutual fund money is always held in cash. You're saying, so what? How much a mutual fund holds in cash is often a reflection of how bullish or bearish that mutual fund manager is. So it's an implicit measure of market timing. If you're bearish about stocks, if you think stocks are overpriced, you're going to hold more cash as a percent of the fund. If you're bullish, that number should drop off. And so we'll start by looking at the evidence on whether mutual funds are good market timers, by looking at whether the cash as a percentage of the fund is a good predictor of what happens to the markets in the following time period. Some mutual funds are specific market timers. They're called tactical asset allocation funds, and their claim to fame is that they don't pick stocks, but they can get you in and out of markets at exactly the right time. So let's start by looking at mutual fund cash positions. In this graph, I've actually graphed out the cash as a percentage of the mutual fund. This is collectively across mutual funds, and the stock returns. So if mutual fund managers were great market timers, here's what you should expect. You should expect to see cash peak as a percentage of the fund just before markets go down, and you should see cash drop off as a percent of the fund just before markets go up. Now, it's very difficult to read this graph, but if you look at the statistics here, what you find is actually a fairly perverse conclusion. You find that mutual fund cash positions peak right after markets have floored. So see this as an example. Let's take this example, 1990. You have a bad year for stocks. Mutual fund cash positions peak in the following year. So if you look across time, what you get actually is evidence of perverse market timing. Mutual funds actually seem to hold more cash just before markets go up and hold the least cash just before markets go down. So in fact, there are contrarian investors who actually take this and reverse it. But collectively, are mutual funds good market timers? The evidence suggests they're not. Let's look at tactical asset allocation funds, because after all, they claim to play just this game, market timing. This is actually from a fairly old study, but what it does was it compared the tactical asset allocation fund to three counters. One is putting all your money in the S&P 500. You don't try to time markets, you invest them all. The other two are what are called couch potato funds. So couch potato fund, 50-50, half your money is in stocks, half is in bonds. 75-25, 75% in stocks, 25% in bonds, and you don't change them at all. So these three are non-market timing strategies. This is your market timing mutual fund. I know this is unfair. You're saying it's one time period, it's a short time, whatever the reasons though. If you look at this particular graph, it's clear that the tactical asset allocation fund not only would have underperformed, somebody who had invested in stocks 100% through this period, but it had been beaten even by the couch potato funds. There have been other studies that have been updated, and what they find in your best case scenarios that tactical asset allocation funds sometimes can time markets, but whatever you gain from timing markets, they seem to wipe out because they're so terrible at everything else in investing. So market timing among traditional mutual funds, the evidence suggests that there isn't much excess return to be made. You think, what about hedge funds? After all, they have the smarter, they must be smarter than mutual funds. Well, let's see if that holds true. There is a paper that looked at the ability of hedge funds to time markets, and it did find timing ability, but it found it only in the bond and the currency markets. In other words, if there's market timing, these hedge funds seem to do it better in bond and currency markets than in equity markets. A more updated, a more recent study did find that a few of these hedge funds were able to time both market direction and volatility. And in fact, one interesting paper looked at not so much market timing in the conventional sense, but how hedge funds were able to adjust their market exposure before changes in liquidity. What I mean by that is often one of the biggest dangers you face as a hedge fund is if you hit an illiquid market, then you get squeezed because you got to get out of position. So if you're able to reduce your market exposure ahead of liquidity changes, you can come out ahead. So the funds that are most flexible, that are able to do that, are market timers in a loose sense, do much better than the funds that are unable to do that don't adjust the market exposure appropriately ahead of market liquidity changes. So overall, some evidence of market timing, at least in non-equity markets, and even in equity markets, some hedge funds at least seem to have found a way to be a little better at market timing than other hedge funds, and that translates into excess returns for these hedge funds. What about investment newsletters? Study Campbell and Harvey actually examined 237 newsletters between 80 and 92, and what they looked at in many newsletters, even though they might not take a point of view on the market specifically, they tell you how much of your portfolio should be allocated to stocks. So presumably, if you're good market timers, that proportion should go up. And what this particular study found, that in 183 out of the 237 newsletters, the returns you got by following the advice in the newsletter about shifting your allocation to stocks was less than what you could have made from a buy and hold strategy. So similar to tactical asset allocation funds, the market timing abilities of newsletters don't seem to be that good. And in fact, when market newsletters advise you to increase the amount you invest in equity, they do that 58% of the time before market upturns, but they also do it 53% of the time before market downturns. No dramatic difference in that advice before market upturns versus market downturns. There is some evidence of continuity of performance. You're saying that's good news. The same newsletters do the same thing. The only problem is much of the continuity is on the downside. In other words, newsletters that give you bad advice tend to give you bad advice on a continuous basis. Newsletters that give you good advice don't seem to have that same continuity. So bottom line, investment newsletters, terrible market timers. At least there's very little evidence of good market timing looking at what they ask you to do in these newsletters. There is some hope here, and that comes from looking at professional market timers. So these are advisors who offer just market timing advice to their clients on how to adjust their portfolio. An old study, again, 2001 study, looked at 30 professional market timers, and it found some evidence of market timing ability. But it found two things. One is that these timing calls were very short term. So if there was market timing, it was about what the market will do over the next week, the next 2 weeks, not over the next year, the next 5 years. And the timing calls were frequent. In other words, you'd have to trade constantly to keep up with these market timers. So one market timer, in fact, in the study had 303 timing signals. Buy, sell, buy, sell. And if you followed that market timer, my guess is your transactions costs would have wiped out not just the excess returns you'd have made from the market timing, but potentially a third of your portfolio. And on average, there were about 15 signals per year telling you that the transactions costs of even following these professional market timers, even their work, are going to wipe out the potential advantages. So the bottom line, looking across people who claim to time markets, is not that optimistic. There isn't much evidence of consistent market timing, whether you look at mutual funds, whether you look at investment newsletters, whether you look at hedge funds or professional market timers. Finally, looking at market strategists. They're pretty high profile. Many investment banks have market strategists who come out and give you their preferred allocation across stocks, bonds, and cash. So even though they might not specifically give you market timing advice, looking at what percentage they ask you to invest in stocks, for instance, is a signal of whether they're bullish on markets and bearish on markets. So if market strategists actually were good market timers, you'd expect to see the proportion allocated to stocks, at least on average, drop off before markets drop and increase before markets increase. So let's see if that in fact holds. This is from a Wall Street Journal study that looked at the best market strategies, the average market strategies, and the worst market strategies, and measured them against two things. One was 100% invest in equity, which beat any market strategist, or a robot blend that actually matched up pretty well to the average market strategist. The best market strategist, of course, was a different market strategist every period, so it's not quite a fair comparison. So basically what this graph again suggests is market strategies or market timing ability, they hide it, at least in their allocation advice. So let's assume that for whatever reason you think you have market timing ability, that you think you can time markets. There are 4 ways you can bring that market timing into play. One is you can adjust the asset allocation mix, the proportions you put into the different markets reflecting your market timing views. More into stocks if you think stocks are cheap, and less into stocks if stocks are expensive. The second market timing strategy, even though it might not be categorized as such, is we know there are some investment styles that do better in up markets and other investment styles that do better in down markets. Maybe you can switch investment styles, go from being a value investor to a growth investor, from a momentum investor to a contrarian investor at exactly the right time, and that could make you some money. You could, and the third market timing strategy, you could rotate across sectors. There is some evidence that some sectors do well in some stages of the market and other sectors do better in other stages of the market. Maybe your market timing skills show up in how you rotate through sectors. Or you can go all out and just try to speculate in markets using instruments that are designed to make you money based purely on market movements. Buy futures, buy options on stocks if you feel on the entire index if you think the index is going to go up. Buy call options, or you can buy put options in the index if you think the index is going to go down. Very risky strategy, but if you're right, you can make a ton of money. So let's look at each of these strategies. The simplest way to incorporate market timing is to adjust your asset allocation mix. So you change the mix of your different asset classes reflecting your market views. The downside of this strategy is you're going to be out of some asset classes if you think they're overvalued, and if you turn out in hindsight to be wrong, you could have given up some money. The most common example for this is the equity market. If you think stocks are overvalued and you allocate less to stocks, you completely come out of stocks, you're going to find that if stocks actually end up going up, and remember, you're going to be wrong a fair amount of the time, even if you're a good market timer, the cost of being out of markets can be so large that it can wipe out whatever potential benefits you get from being even a fairly reasonable market timer. So that's the first choice. The second is style switching. There are some strategies that work better in bull markets, others that work better in bear markets. In fact, when we looked at value versus growth investing earlier in these sessions, we found that growth and small cap investing did much better in certain macro and market environments than value investing did. So if you can time those market cycles and move from value stocks to growth stocks and growth stocks back to value stocks with perfect foresight, and there's a study that actually looked at it, with perfect foresight, you'd have made much, much larger returns, 21, 25, 27%, much larger returns than you'd have made investing in the entire market over that same period. So if you can pull it off and switch investment styles at exactly the right time, all the more power to you. The problem, of course, is switching those styles at the right time. Okay? So that's the underlying weakness here. If you switch at the wrong times, you could get pummeled. You could end up with the worst of all of these styles as your end result in your portfolio. There's sector rotation. This is from a classic graph from a group that believes that you essentially, so this is from a colleague of mine, it's Robert Stowell, who teaches at NYU. And he basically has a graph that shows you which groups of companies, cyclicals, technology, industrials, you should be in each stage in the cycle. So this is actually the economic cycle. There's the market cycle. So essentially it links the economy to the market and then tells you which sectors do best in each stage of the cycle. So if you're in sector rotation, here's what you will need to do. You need to figure out where you are in the economic cycle, figure out what it means in terms of the market cycle, and then pick the sector that does best at that point in the cycle and ride the sector rotation to higher returns. Again, if you can pull it off, it can be a very lucrative strategy. The key is, first, that this relationship, which is based on history, continues to hold, and second is rotating out and rotating in at exactly the right times. And finally, the speculation. You can go out and, especially in today's market, speculate in the direction of stocks. By using derivatives, you can buy futures on the index. You can buy call options if you think the index will go up. You can sell futures or buy put options if you think the index will go down. It's a high risk, high return strategy because if you're wrong, you could lose everything. You could make a huge negative return. If you're right, you could make 300 or 400% returns. In my view, it's a far too dangerous a strategy to have your entire wealth invested in. So, but if you're a market timer, you might set aside a portion of your portfolio, maybe 5-10% of your portfolio, dedicated to speculation. And if you're right over time, more often right than wrong, perhaps that 5 or 10% of your portfolio will deliver good returns over long time periods. So the market timing instruments you can use can range from futures contracts, and you can have futures. There are futures contracts in pretty much every asset class. You can have options contracts on many asset classes again. And an added bonus, especially in the last decade, is exchange traded funds. You can essentially make market timing bets not only across different asset classes, but within asset classes across different types of subclasses. So for instance, if I thought that Indian stocks were overpriced relative to Brazilian stocks, or that gold was overpriced relative to silver, there's an exchange traded fund I can use for any of those bets to kind of augment those bets. With greater freedom comes greater responsibility. These securities allow you to bet on things you couldn't have bet on 10 years ago, 20 years ago, 30 years ago. That's a mixed blessing because more people are betting on more things. And because most people are not that good at betting, it ends up losing them more money than making them money. But at least we know the choices exist. So here's the bottom line. Do you want to be a market timer? If you think you can be a market timer, go for it. I think you can be both a market timer and a security selector. It's not an either or. I'm not asking you to pick. The question is, do you want to augment the returns you make on one with the other? So you can be both a market timer and a security selector, but there are two caveats I would add. One is, if you believe you're both a market timer and a security selector, check your performance on both dimensions. Be honest with yourself. If after 5 or 10 years of trying this, you find that you've been a much better security selector than a market timer, give up on the market timing, focus on security selection. If you find that you've been a better market timer than a stock picker, then stop picking stocks, go to being a market timer. You have only so much time and resources to invest. Invest it where the payoff is greatest. And second, if you find that your market timing is undercutting your stock selection, that your investment philosophy is getting to perform worse because you're trying to be a market timer, maybe it's time to pause your market timing and go back to security selection. So in these last few sessions, we've looked at market timing. It is a dream we all have. If you can be a great market timer, you can make superb returns. Everybody tries to do it. Very few people seem to be able to be consistent winners with market timing. But that doesn't mean you shouldn't try. And if you can be a consistent winner with market timing, all the more power to you. Thank you very much for listening.